Okay, let's just chat about some of the other participants as well. And Nikun just pointed out in terms of the bank nifty being weak. Yes Bank is one such case in point which continues to reel under pressure. Those are some of the other sectoral pictures as well for you. But let's bring on board Ajay Kaul, CEO at JubilantFoodWorks, and chat about the earnings. Ajay, hi, morning. Top line and bottom line both have missed the analyst estimates. What's the company doing to beat the slowdown?
Lots of things. Actually, if you ask me, the last few months have been probably the most exciting from an internal company employee invigoration perspective. Unfortunate bit is that we have missed some of the investor expectations, but that doesn't deter us because we believe strongly in the long-term growth story in India, and I will elaborate that in a moment. If you look at last year, and then I'll come on to this quarter, we had spent nearly 70 to 80 crores of rupees in building, two new commissaries, one in Mumbai and one in Kolkata, and a brand new one in Chandigarh, close to Chandigarh that is. And all this was keeping in mind the long-term prospects of the country, opening new stores, getting into the hinterland and so on. Even this year, we believe we will end up spending at least 60 to 70 crores in starting to open 3 brand new commissaries, one somewhere in central India, one in Hyderabad and around, and one in somewhere in northeast, probably Guwahati, and relocating our North India commissary, which is in Noida. The point I'm trying to make is all these investments are keeping the next 4-5 years in mind. And why so? Because we believe this year we should open at least 125 new Domino stores, at least 18 new Dunkin' Donut stores. And trust me, while everything we hear in the economy, downturn and so on, is kind of real, because if you look at our same store growth for this quarter, given that we have done 30 and 35% also in the past, 6.3% kind of doesn't measure up. But in terms of our experience in the hinterland, when we go to places like Erode, Baramati, these are the places where we opened new stores in the last quarter. Outstanding. Haldwani, outstanding, reception from customers. So I think in those small towns, while there is that downturn and all that, which is all pervasive in India, but there is aspiration-led demand, call it latent demand, call it, that pent-up thing, which is giving us exceeding results. Our return on investment or return on capital employed for new stores and thereby paybacks and all that is all intact. So we are gung-ho about the future story, the long-term growth story of India. In the short run, the short answer to your question is there is a bit of a blip, but we are optimists. If I look at, quarter one itself, while 6.3% is our same store growth, June was better than May, was better than April, without divulging any numbers. So that will probably give you an indication that probably things are improving a little bit, or it's probably a consequence of all our, deployment of, call it, promotional arsenal, call it arsenal, call it, hathiyar, as we often say. We are very, very hopeful that as we kind of get into the second half of the year, same store growth should climb back, and we should end up the year anything between 8 to 10%, while we started with 6.3%, and we have reasons to believe in that. One more indicator I would like to leave with you, even in a tough time like this, is compared to last year, which is 2011, if I look at 2012 full year, our market share within the space, which is an indicator of, while the environment is tough, how well were you still doing vis-a-vis competition and what everybody else was doing. Our market share has climbed from 62% to 67%. It makes our position that much more indomitable. It makes us clearly the largest and the fastest growing MNC QSR brand in the country. Now we can derive a lot of joy out of that, but that doesn't deter us. I think the larger picture is, how do we take care of the downturn? How do we climb our same store growth numbers back to respectable 8 to 10%, if not more, in more longer term future and so on.
As a percentage of your total sales, Ajay, how much is coming from existing stores and how much will come from new stores?
See, the new stores as a percentage, because brand new stores, let's say if you open 125 stores this year, since they open throughout the year, so you will have to take half their impact, because some will open on 1st April and some will open probably on 31st of March 2014. So overall it's a double digit just about there. So the impact is small still, but progressively as you move into the years, their impact starts becoming larger and larger. We actually categorize our stores into three buckets. One is the old stores, on basis of which we, ascertain the same store growth. Then there is B category stores. These are stores which opened last year, and now this year they will have a full year in front of them, but they are not a part of the same store calculation. And then there are the brand new stores. I would say the first category of stores which is taken into account for same store growth calculation contributes to a good sizable 70% of the business.
70-80% is slowing down. That is the problem. Because what you've done in Haldwani, Baramati,
Absolutely.
These are new stores, they're growing, but it's the existing business which is under pressure.
Absolutely.
So you plan to invest about 250 crore rupees on capex this fiscal to expand network of restaurants. What's the kind of growth that you do foresee from the new stores that you just talked about?
See, I'll repeat myself here. 250 crores is a right number. I would say 60-70% of this will go into opening new stores, both between Dunkin' Donuts and Domino's brand. As I said earlier, 125 at least Domino's stores. We had done 111 last year, so that's clearly on track. 18 stores in Dunkin' Donuts, which is again on track. The rest of the capex is going into starting work and building 3 brand new commissaries, 3 new factories. See, currently we have 5. We're going to add, 3 more to that. One somewhere in central India, one around Hyderabad, one around Guwahati. So that is as far as capex is concerned, and all through internal accruals, no dampening of spirit there, no looking back, because we believe that these short-term blips are there, but long-term is where the growth story is. Call it medium-term is where the growth story is. Coming to new stores was your more pinpointed question. We are expecting, in fact, if I look at average weekly sale or average monthly sale generated by new stores opened this year, it's a significant improvement over last year. Which means that even while we go to places as, call them obscure, as an Erode or a Baramati or a Haldwani, the sales generated by them are firstly very, very good. Secondly, which is more important, is how easily or how fast would they do their paybacks or return on capital employed and so on. It's as fast or faster than what we have seen in the past for other stores. And that is a great indicator for us in terms of investing capital into the right direction. And till the point that is happening, till the point we get our returns in less than 3 years, we are happy to open more and more stores, and in long term they are the ones which start then accelerating and giving us growth. And we are very hopeful that give another 6 months or so, for a highly impulse purchase category like ours, where the outlay of a ticket is just about 300-400 rupees. People can defer their car decisions and other personal capex decisions like a motorcycle or a fridge or a durable, but it's not for too long that high discretionary spend items, high impulse purchase driven categories like ours, you can keep down for too long. So we believe it will come back. Half two is going to be clearly better than half one, and 8-10% same store growth is what we should deliver as we progress.
Just tell us, when are you opening Dunkin' Donuts in Mumbai? Because Nikunj and I are itching to get our first piece.
Tell me where your residences are. We'll have to look for a place very close to your houses, I think.
I hope the rentals do you
every time.
Okay, so very quickly, talking about... Sorry, what's that?
No, the work is on, the feasibility reports, the ground level work is happening. And I think, by the close of the year, we should be clearly looking at opening our first Dunkin' store somewhere in Mumbai. For your information, we have already started investing, into our factory, our existing facility of Domino's in Mumbai. Within that, we have carved out space for our Dunkin' factory. So this is synergies which we are trying to draw between the two brands to minimize capex, to minimize operating expenditure also, and thereby obviously getting profitability faster.
Okay, we're waiting for that. Very quickly then, revenues from Dunkin' Donuts up until now, and what is it that you target for FY14 close?
See, I can't give you a future guidance. 80 new stores is clearly, at least 80 new stores is what we plan to open for Dunkin' Donuts. Later part of the year, we intend to, come to Mumbai. Research is on and field level work is going on there. But one thing which I want to add here is, Dunkin' Donuts, will always play a very, very small role, and which analyst investors by now have realized vis-a-vis the big brother, which is Domino's. Because as we, just to give you, a medium-term perspective to the whole thing, we believe in 4 to 5 years' time we will have, let's say, 100 Dunkin' stores. At that time, we believe the Domino's store count would probably be in excess of 1,000. So, in perspective, it will always be a smaller brother. It will always not have a huge impact either on the revenue side or on the EBITDA side. But it is very important for us because we want to make another Domino's success out of the Dunkin' brand, and all investments, all the work which is happening right now in terms of getting all the parts of the model right, whether it's the real estate model, size versus location and so on, whether it's the menu mix model, the pricing model, the people model and so on, all iterations are happening. We are almost reaching conclusions on many of these kind of verticals, and we believe that soon we will know that this is exactly the strategy and the model to follow, and then is when we will replicate, or then we'll move much faster.
Final question, typically how companies react in a slowdown is that they try to gain more market share either by innovation or by cutting price. Are you looking at cutting pricing?
Not at all. We do not believe, firstly, that this downturn is going to be, lasting for too long, the classic downturn. Some industry categories probably are affected more, and maybe that's the stance they would take. But high discretionary spend-led impulse purchase category like ours, it can't, be too long before things become kind of normal. They may not get back to the 30% same-store growth numbers which we have seen in the past, but they will definitely climb back. So that is one part. So no cost cutting, but I would say cost efficiency. We engage Six Sigma techniques in our company. We are probably the only company within our industry who engage Six Sigma and deploy Six Sigma in a big way. So cost efficiency is the name of the game from inside. But more importantly, two things: investment on the brand, investment on new product development, investment on our people, investment in the area of infrastructure building. That is going undeterred. If you see, we launched Ye Hai Khushiyon Ki, Ye Hai Rishton Ka Time as a new positioning last year. A lot of money went after that. Investment on people in terms of training them, leadership development pipeline and so on. In fact, we are doubling our training budgets this year, even in a tough year. Investment in commissaries, factories, I have spoken about. Fourth is investment in technology. Today 20% of our deliveries actually happen through the net, which means the order is booked through the net, as high as 20%. We believe this number can easily become 30, 40 and 50 going forward, given the profile of our customers and so on. So a lot of investment is going into online ordering technology, making it easier for customers to order and so on. We believe all this is basically looking at future. So cost efficiency and not price cutting, and investment in brand, investment in people brand, and investment in infrastructure as opposed to pulling out infrastructure. It so happens, as I said earlier, that our market share has climbed by 5 percentage points, but that is not what bogs us down. We are not market share, frenzied company. We are looking at growing the market and taking the consumer along with us.
Well, Ajay, I really appreciate your time, and I sincerely hope you bounce back because slowdown, no slowdown. I can tell you one thing for sure, that Aish and me, we both love your pizzas.
Thank you. Thank you very much. Keep eating.
Let's take a break. When we come back,